Good afternoon, boys and girls. Welcome to Thursday's Liberty Call. It is July 28th, 2022. Hope everybody's having a great day out there. It's a little gloomy here in Colorado. We've had a bunch of rainstorms over the last couple of evenings, and today, I guess the clouds decided to stay over our lovely part of the world. So it's currently 67 degrees, which is a little chilly for a lot of people for summertime. You know, we kind of welcome it. It's been a little warm here the last few weeks. And, we're glad to have to not sweat so much when we're sitting here in the house. So anyways, like I said, hope everybody is having a great day. If it's your first time watching, give me a big old thumbs up, like, a share, a subscribe, all that good stuff. I would greatly appreciate it. And, kind of a weird day in the market. The news today was that we are officially in a recession, even though the administration is busy trying to adjust the definitions of things. But based upon, the most simple version, 2 consecutive quarters of negative GDP means we're in a recession. So yes, you could have outlying conditions as far as the job market and other stuff like that. But, it does look like things are slowing down. So it's really not a surprise. Even though some of the articles that we're going to share today, they seem to like it's kind of caught off guard. Hey, it's weird. Things have slowed down. It's kind of a mystery. But I think if you've been paying attention to what's really been going on, it's really not a surprise. So anyways, all right, well, let's go ahead and jump in and take a peek at how the markets reacted today. Like I said, they did quite well, all things considered. The Dow Jones was up 1.03%, or 332 points, closed at 32,529. S&P 500 was up 1.21%, closed at 4072. NASDAQ was up 1.08%, closing at 12,162. Small caps are also up 1 1/3. The VIX fell back another 3.92% today. It's currently sitting at 2233, still above 20, which anytime the VIX is over 20, that does give you a little bit of caution on where things are headed long term. Moving on to the other countries, Canada was up 1.05%, Brazil up 1.14%, Mexico up 2.71%. Jumping across the Atlantic, Germany up 0.88%, UK was flat at down 0.04%. France was up 1.3%, the Euro Stoxx up 1.23%, Netherlands up 1.24%. Spain was down 0.49% today. Italy was up 2.1%. Switzerland up 0.66%, and Portugal up 0.72%. Let's move a little further east. Over in Russia, the MOEX was down 0.32%, and the RTSI was down 1.4%. Headed over to the Asian markets, Japan was up 0.36%, Australia up 0.97%, New Zealand up 1.53%. Moving over to China, the Shanghai was up 0.21%, the SESE component up 0.23%, China A50 was down 0.14%, DJ Shanghai up 0.1%, and the Hang Seng down 0.23%, and the Taiwan weighted came in down 0.2%. So, most of the day, lots of greens across the board, and, highlighted by the domestics, which were up more than 1%. So, again, a little surprising on the negative news coming out of, somewhere in Washington, one of those important departments, with the data that we are officially in recession. But again, we'll see where this takes us long term. I get more spam calls of late. I'm not sure why. Let's actually take a look at the chart and see what's going on there. This is the Dow Jones again. Starting at the beginning of the year, we've been in this downward trend. This is the third time we've broken through this resistance line right here. And, the first time it did, we got a pretty decent separation from this resistance, but again, fell back in line for a couple of months. Then we had a short break above here in late May. That was short-lived. It was only about 2 weeks. And, we'll see where this goes. If this trend continues and we see some crossing on some of these other charts like the MACD, Hey, maybe this is we have a little bit of a rally for the next couple of months. But again, I don't want to get ahead of ourselves. Let's see where where things really line up, and if this downtrend is coming to an end, or if this is just another bear market rally. And we got. If I were to guess, I would say this is probably gonna fall back in line with the longer term trend. But there's you always have to break the trend sometimes. So we'll see where that goes. All right, let me get rid of that. And let's go ahead and read through today's market recap. S&P 500 climbs as surprise slip in U.S. growth fuels bets on less hawkish Fed. See, again, right there, a surprise slip. This is not a surprise to anyone paying attention. I mean, the Atlanta Fed, for at least the last month, has been saying that GDP would probably be down about, I think the last number I saw was down 1.2%. But, again, this isn't surprising by any stretch. The S&P 500 climbed Tuesday after an unexpected decline in the U.S. economy stoked optimism that the Federal Reserve would be forced to reassess the pace of rate hikes. The economy declined 0.9% in the second quarter, the Commerce Department said in its first estimate on Thursday, confounding estimates for a 0.5 increase. So again, they were talking an increase in GDP for the second quarter. And, everything I've been reading for the last, 4 to 6 weeks has said, we're probably going to be down around 1%, and they were estimating a 0.5% increase. It was the second quarter of contraction, pushing the economy into a technical recession, but economists were quick to downplay the severity of the data on expectations that growth will rebound when inflation starts to slow. Quote, inflation was clearly the big culprit and the biggest drag on real GDP growth, end quote, Jeffrey said in a note. Quote, if we sustain this type of nominal growth and inflation slows, as it appears to be doing at least so far in July, real GDP growth will accelerate meaningfully in Q3, it added. Treasury yields continue to price in the prospect of a less hawkish Fed. The U.S. two-year Treasury yield, which is sensitive to Fed rate hikes, was off its lows, but fell below 3%. We expect the Fed to step down to 50 basis points in September, but see upside risk based on continued higher readings in inflation, Morgan Stanley said in a note. Tech stocks added to gains from a day earlier, but upside were kept in check by a 6% slump in Meta Platforms, following weaker than expected quarterly results and guidance pressured by a slowdown in advertising spending. The more than 50% slump in Meta shares this year has caught the eye of bargain hunting investors, but RBC said the social media giant has to stem market share loss from TikTok and improving targeting, quote, before the stock breaks out of its current valuation range, end quote. Etsy, however, reported quarterly earnings and revenue that topped Wall Street estimates despite the weaker economic backdrop that impacted engagement on its platform. Its shares jumped more than 8%. Chip stocks were up less than 1% amid pressure from Qualcomm after the chipmaker's guidance fell short of estimates, as slowing handset sales growth will hamper chip demand. Utilities led the sector gainers as renewable stocks soared as the climate deal struck by U.S. Senators Joe Manchin and Chuck Schumer on Thursday is expected to ramp up renewable energy development and growth. Constellation Energy, Plug Power, and Sunrun Inc. were up more than double digits. In other news, JetBlue Airways reached a deal to buy Spirit Airlines for $3.8 billion after a months-long battle to acquire the low-cost carrier. The deal is, however, expected to face scrutiny from regulators. So again, pretty decent day. We'll see if this is part of a longer-term trend, or like I said earlier, is this more of just a bear market rally? We've seen lots of these over the years when we've been in downturns. So be careful before putting too much dry powder to work, because you might be getting a good deal today, but it could turn into a bad deal later on. All right, next article here, U.S. teetering on brink of recession as GDP contracts in the second quarter. The U.S. economy unexpectedly contracted. Again, there's that word, unexpectedly. It was not unexpected. In the second quarter, with consumer spending growing at its slowest pace in 2 years and business spending declining, raising the risk that the economy was on the cusp of a recession. While the second straight quarterly decline in GDP reported by the Commerce Department on Thursday largely reflected a more moderate pace of inventory accumulation by businesses due to ongoing shortages of motor vehicles. The economic profile was weak, with exports as the only bright spot. This could deter the Federal Reserve from continuing to aggressively increase interest rates as it battles high inflation. The U.S. Central Bank on Wednesday raised its policy rate by another 0.75 percentage point, bringing the total rate hikes since March to 225 basis points, or 2.25% for you regular people. Quote, the economy is highly vulnerable to slipping into a recession, said Sal Gutierrez, a senior economist at BMO Capital Markets. Quote, that might discourage the Fed from ramming through another large rate hike in September, end quote. GDP fell at 0.9% annualized rate last quarter, the government said in its advanced estimate of GDP. Economists polled by Reuters had forecast GDP would rebound at a 0.5% rate. Estimates ranged from as low as a 2.1% rate of contraction to as high as a 2% growth pace. The economy contracted at 1.6% pace in the first quarter. It shrank 1.3% in the first half, satisfying the definition of a technical recession. But economists, the Fed, and the White House say the economy is not in a recession based on broader measures of the activity. The National Bureau of Economic Research, the official arbiter of recessions in the United States, defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in production, employment, real income, and other indicators, end quote. Job growth averaged 456,700 per month in the first half of the year, while domestic demand continued to grow. Quote, there is without a doubt an underlying slowdown in domestic demand in evidence here, said Brian Coulton, chief economist at Fitch Ratings in New York. Quote, but this number does not signal an early arrival of inflation and Fed tightening-induced recession the markets have recently been focused on, end quote. The White House sought to calm voters ahead of the November 8th congressional elections that will decide whether President Joe Biden's Democratic Party retains control of the U.S. Congress. Treasury Secretary Janet Yellen touted administration's achievements over the last 18 months, including robust employment gains following record job losses at the height of the COVID-19 pandemic, and described the economy as resilient. Yellen, however, acknowledged that activity was slowing and warned of numerous risks on the horizon. Quote, this report indicates an economy that is transitioning to a more steady sustainability growth, end quote, Yellen said in a news conference. Stocks on Wall Street were trading higher, the dollar edged up against a basket of currencies, and U.S. Treasury yields fell. Again, the achievements over the last 18 months, I find that funny. We are only in this position because the government shut down the economy and printed a bunch of money. But hey, we've done some really good stuff. So anyways, all right, next article up has to do with the inflation fighting bill that Manchin and Schumer supposedly have come to terms on. We'll go ahead and read through this. It is the bill is over 700 pages. So if you want to read through that, there is a link right here in the article that is attached. So feel free. They also put out a one-page summary that we'll read through in a minute. All right. Senator Joe Manchin reached a deal with Senate Majority Leader Chuck Schumer on the Inflation Reduction Act of 2022. And that's a little bit funny. They're going to reduce inflation by spending government money. Isn't that what got us into this situation? A summary of the deal says it will make a historic down payment to help the economy and fight climate change. Full text of the bill was dropped on Wednesday night. So let's go ahead and read through just the summary of this. See if I can make this a little bit bigger. All right. The Inflation Reduction Act of 2022 will make a historic down payment on deficit reduction to fight inflation, invest in domestic energy production and manufacturing, and reduce carbon emissions by roughly 40% by 2030. Yeah, that'll happen. The bill will also finally allow Medicare to negotiate for prescription drug prices and extend the expanded Affordable Care Act program for 3 years through 2025. I have no problem with Medicare negotiating drug prices. Not that the federal government should be in the business of, doling out health care. I mean, I've read through the Constitution more than once. Never seen anything that says that that's within their jurisdiction. But hey, The new proposal for fiscal year 2022 budget reconciliation bill will invest approximately $300 billion in deficit reduction and $369 billion in energy security and climate change programs over the next 10 years. Additionally, the agreement calls for a comprehensive permitting reform legislation to be passed before the end of the fiscal year. Permitting reform is essential to unlocking domestic energy and transmission projects, which will lower costs for consumers and help us meet our long-term emissions goals. And here's some bullet points. Enacts historic deficit reduction to fight inflation. Okay. Well, reducing the deficit doesn't really reduce the debt. It's just reducing the amount of overspending every year. So, I mean, we haven't, spent less than we brought in really since Bill Clinton, and that was over 20-something years ago. Lowers energy costs, increases cleaner production, and reduces carbon emissions by roughly 40% by 2030. Not sure how that's going to occur. Allows Medicare to negotiate drug prices and caps out-of-pocket costs to $2,000. Lowers ACA health care premiums for millions of Americans. Makes biggest corporations and ultra-wealthy pay their fair share. Again, most of these are just platitudes. It's not really saying anything. There are no new taxes on families making $400,000 or less and no new taxes on small businesses. We are closing tax loopholes and enforcing the tax code. Okay, great. All right, well, let's jump into this. Manchin, a West Virginia Democrat, helped thwart President Joe Biden's efforts to establish an expansive Build Back Better plan aimed at climate, economic, and healthcare progress. The deal that Manchin and Schumer struck is a skinnier version of Biden's original plan. Quote, for too long, the reconciliation debate in Washington has been defined by how it can help advance Democrats' political agenda called Build Back Better. Build Back Better is dead, and instead we have the opportunity to make our country stronger by bringing Americans together, the West Virginia Democrats said in the statement. Senior Democrats intend to pay for the deal through a 50% corporate minimum tax, IRS tax involvement, and closing a loophole that benefits wealthy investors. Quote, I will do everything I can to usher in a new era of compromise and common sense that will make America more energy secure, financially sound, and a more united country for this generation and the next, he added. Energy and climate. The New Deal goes against Manchin's previous comments suggesting he would not support spending on climate change. It will allocate $369 billion to energy security and climate change, working to lower carbon emissions by 40% by the end of year 2030. Part of this is achieved with new tax credits for electric vehicles meant to encourage more Americans to buy them. I will not. Under the new bill, Americans qualify for a $4,500 tax credit to buy used electric vehicles, depending on their annual income. The amount increases to $7,500 if it's a new EV. It sets aside $60 billion for manufacturing of domestic clean energy. There are also tax credits to slash the cost of heat pumps, water heaters, and rooftop solar energy. This bill aims to bring down energy costs as well. Excellent. The Affordable Care Act extension. An estimated $64 billion will be focused on the extension of the Affordable Care Act, also known as Obamacare, for an additional 3 years through 2025, 1 year longer than Democrats had suggested. Americans purchasing insurance under the program would pay no more than 8.5% of their income for coverage. Wow, thanks. Middle-income families would qualify for financial assistance for the first time, and lower-income households would pay little or nothing for insurance. The extension does not impose additional restrictions for who is eligible, otherwise known as a means test. The program was first established under the Biden stimulus law last year and is set to expire at the end of 2022. Democrats are racing to prevent the program from ending since voters would receive notices of their spiking premiums only weeks before the November midterms. Yeah, again, all this free and low-cost insurance, who's picking up the tab? The taxpayer. And again, this is not in the jurisdiction of the federal government. We should not be doing this, but hey, people like free stuff, and that's what they vote for. Prescription drug reform. The deal also allows Medicare to negotiate the price of 10 prescription drugs starting in 2026. Okay, so 4 years from now. That will do very little to help today. A top Democrat goal. That amount increases over the years. It also caps out-of-pocket costs for seniors relying on Medicare Part D at $2,000 annually. The bill also penalizes drug makers if they increase prices faster than inflation rates. Then Medicare beneficiaries would qualify for free vaccines. Ooh, because vaccines have helped so much. However, it omits another major priority for Democrats, capping the cost of insulin at $35 per month. That forms part of the bill by Democratic Senator Jeanne Shaheen of New Hampshire and GOP Senator Susan Collins of Maine. What I really see here are price controls. And, what we learned from the Great Depression was price controls caused more problems than good. All right, so I guess that's it. Like I said, it is a 725-page bill. You can read it here. It is in a lot of legal talk, so a lot of fun there. But from the way it sounds is we're going to be spending a lot more money to combat inflation, which makes about as much sense as a rubber crutch. All right. Last article here has to do with what happened today. Opinion: the Fed vowed to crush inflation with higher rates. Then the stock market rallied, and here's why. It's not good news. Quote, we are now at levels broadly in line with our estimates of neutral interest rates, and after front-loading our hiking cycle until now, we will be much more data-dependent going forward, end quote. Jerome Powell at yesterday's press conference. The Federal Reserve on Wednesday raised the interest rates by another 75 basis points, despite acknowledging that economic growth is clearly slowing. The central bank under Powell reiterated that the path of least resistance is well represented by the so-called dot plot. More hikes ahead, all the way to a Fed funds rate of 3.75%. Isn't inflation 9%? And yet the stock market has staged a humongous rally led by most valuation sensitive and risk sentiment driven asset classes, NASDAQ stocks, and crypto. So what the heck? It all boils down to one single sentence was able to affect the probability distributions that investors were projecting for different asset classes. Does it sound complicated? Bear with me, it's not. When the FOMC press release was published, it looked like business as usual, a well-telegraphed 70 basis point hike with the only small surprise representing a unanimous vote despite clear acknowledgement that economic growth is softening. But not even 15 minutes into the press conference, the fireworks went off. In particular, when Powell said, quote, we are now at levels broadly in line with our estimates of neutral interest rates, and after front-loading our hiking cycle until now, we will be in a much more data dependent going forward, end quote. This is very important for several reasons. The neutral rate is the prevailing rate at which the economy delivers its potential GDP growth rate without overheating or excessively cooling down. With this 75 basis point hike, Powell told us the Fed just reached its estimate of neutral rate, and hence from here they aren't contributing to economic overheating anymore. But that also means that any further increases are going to put the Fed in an actively restrictive territory. And the bond market knows that every time the Fed becomes restrictive in the past, they ended up breaking something. Until Wednesday, you could be completely sure that the Fed would have just pressed on the accelerator. Inflation must come down. No space for nuance. So journalists asked the question to find out something about the new forward guidance. It went roughly like this. Journalist, quote, Mr. Powell, the bond market is pricing in you to cut rates starting in early 2023 already. What are your comments? Powell, hard to predict rates 6 months from now. We will be fully data dependent. Journalist, Mr. Powell, due to the recent bond and equity market rally, financial conditions have eased quite a bit. What's your take? Powell, the appropriate level of financial conditions will be reflected in the economy with a lag, and it's hard to predict. We will be fully data dependent. Kind of a broken record there. He did it. He totally ditched forward guidance. And what happens when you do? You give markets the green light to freely design their probability distributions across all asset classes without any anchor. And that explains the gigantic risk rally, as well as a jump in the broader market or the broader S&P 500. Let's see why. If the Fed is so data dependent and there's basically one data they care about, it all boils down to how inflation will evolve in the near future. And the bond market has a very strong opinion about that. Using CPI inflation swaps, I calculated the one year forward and 1 year inflation break-evens, basically the expected inflation rate between July of 2023 and July of 2024, which is represented in the chart above, sits at 2.9%. You can see that right there. Remember that the Fed targets PCE, which is core inflation, which tends to historically be 30 to 40 basis points below core CPI. Essentially, the bond market expects inflation to slow very aggressively and roughly hit the Fed's target in the second half of 2023 already. So if the Fed is not nearly on autopilot anymore and markets have a strong opinion on inflation and growth collapsing, then they can also price in other asset classes around this best case scenario. It starts to be more clear, right? If the Fed isn't going to blindly keep hiking rates, but keep more data dependent, contingent on their view that CPI will come down, will quickly come down, traders have a green light to price in more nuanced tightening cycle, and hence still expect restrictive real yield, but less so than before. And indeed, 5-year forward, 5-year U.S. real yields rallied 11 basis points and hit their lowest level in over 2 months. When real yield declines, valuation-sensitive and risk-sentiment-driven asset classes generally tend to outperform. That's because the marginal inflation-adjusted return for owning cash U.S. dollars becomes less attractive, and the real discounting rate for long-term cash flows becomes much less punitive. Thus, the incentive to chase risk assets is larger. Actually, following this narrative, one would argue that the riskier, the better. Here's a chart that's showing a very tight relationship between real yields and equity market valuations. And you can see that right here. So guess who the two main characters of the crazy market rally were? US tech and crypto. But let's now answer the real question. In this giant puzzle called global macro, all the pieces falling into the right place to fully support this narrative. In short, the crazy market rally was spurred by Powell's ditching of the Fed's forward guidance and kickstarting, quote, fully data dependency, end quote, season. Given the bond market's strong opinion on inflation going forward and no autopilot by the Fed on a tightening cycle, investors went ahead and repriced all other asset classes accordingly. If the Fed isn't going to blindly hike us into a recession and contingent on inflation slowing quickly as priced in, then fewer hikes now, fewer cuts later, or a curve steepening. Lower real yields, Fed won't keep policy ultra tight for too long, and risk sentiment-driven asset classes can rally. So does the new narrative pass the global macro consistency test? No, not really, and for two main reasons. One, this is the most important inflation fight that central bankers have engaged in over 35 years, and history suggests a, quote, mildly restrictive stance won't be enough, meaning they're not raising rates fast enough. Slaying the inflation dragon is generally not done with baby steps, and that's been true across different jurisdictions and historical circumstances. For instance, the last time inflation was stubbornly high in France, the central bank had to bring nominal rates all the way to 8% and keep them there for years to bring down CPI, way above my estimate of prevailing neutral rate, blue at 4.5%. Assuming the Fed will be able to engineer significantly lower inflation while already taking the foot off the gas pedal seems very optimistic. Number two, ditching forward guidance increases volatility in bond markets even further, and a volatile bond market is an enemy for risk assets. Let's assume the next inflation print is worse than expected in absolute terms, momentum, and composition. A fully data-dependent Fed will have to consider a 100 basis point hike in September, very likely to generate mayhem in the markets all over again. While ditching forward guidance might be the right monetary policy strategy amid these uncertain times, when there is no anchor for bond markets, implied volatility will have a hard time falling. And higher volatility is one of the biggest, most liquid markets in the world. Generally requires higher, not lower risk premia everywhere else. To sum it up, the Fed can't and won't stop until the job is done, and the job will be done only when inflation has been killed, with likely big collateral damage inflicted on labor market and the broad economy too. So hold your horses. So based upon who was the gentleman who wrote this? Let's get back up to the top. Alfonso Pecatiello. So based upon his opinion that they're doing more harm than good. And well, again, most of these talking heads that who work for these big agencies, they're more worried about keeping their jobs and keeping the administration happy. So if they got to tell a few white lies to keep the masses at bay. I guess that's what they do. I'm more of a blunt type of person. I prefer just to tell it like it is and, take your medicine. But anyways, all right. Well, that's everything I had for today. It went a little long, about 30 minutes, but that's some important stuff. It has to do with how much the government's going to rob us from taxes or for taxes and, what they're doing to curb the inflation that they caused. So we'll see if they actually get through this and do it the right way or in a clean way, or will it be carnage and a giant train wreck at the end? So we will see. All right. Well, if you're worried about what's going on, please go to dsafinancialgroup.com. You can book a meeting. We can sit down and talk about everything that's going on in the world and how you can prepare for all this stuff. And I'll be back tomorrow with the weekly wrap up, wrapping up all the data for the week and see where we're headed moving forward. So hope everyone has a fantastic evening, and I'll talk to you tomorrow. Bye.